inflation adjusted usually means the government sets up the standard of judging what's inflation adjusted. And they're the same people who destroy the unit of measure, the money unit. So why am I going to trust their quote, their unit of measure of what the change in the quant, et cetera. Even the Federal Reserve has recently discontinued the use of, so they don't want us to see the underlying metrics and things like CPI and stuff like that are so biased in the way they're constructed and so unreality based that I don't even pay attention to them. The other day we just had a CPI number and it was a dramatic thing. And of course, it's measured all kinds of ways, like, how much was it up, but versus last year? Well, last year we were in a big hole. So naturally it's going to be up a lot versus last year. I'm more concerned with the reality of the money unit expansions, which we now don't see with them too anymore. But, we know money supply in the U.S. has gone off the page.
Yeah.
Not just doubling every decade. We're now probably doubling every year at the rate we're going, if we continue. And they'll find reasons to continue. It's not just the virus. We look at stuff that is likely to last, at least several months at minimum, preferably quarters or several years. So we're looking at the bigger picture of all the markets we analyze. And we analyze all four categories. It would be stocks, debt market, foreign exchange, and commodities. Now, obviously, for example, we had a big bull market in gold from 2000 up to 2011.
Yeah.
And that fit with, a libertarian view, positive on gold because it's real money. The governments can't distort its quantity. It tends to hold its value over time. Yes, it oscillates just like any other asset, but it tends to hold its value over time. But in 2011, at 1900, as soon as it backed off from that high by, about $100 or so into early 2012, we turned major bearish. Now, it's not like the fundamentals had suddenly changed. I mean, governments were still printing money, et cetera. We had monetary expansion. So why didn't I stay bullish? Well, annual momentum of gold, as we measured it, and that was to measure monthly prices in their relationship to a 36-month average, which is a smooth 3-year average. If you looked at the price chart, it was ballistic. You could hardly even draw a trend line. But if you looked at the annual momentum chart, it was a beautiful staircasing, multiple hits along an angle where, a blind man could have seen it. You had 7 precise hits on a trend line that went back about 3 years. So there was a structure there to break. It was, if you knew if it broke that line, something was wrong. Well, it broke that line only a few months off the high. And it spent the next year and a half to all of 2012 and into early 13, flip-flopping around, not making new highs, but just holding itself together. And we still remain bearish. And most gold bulls were still bullish. And yet we set aside our fundamental view of gold long-term as a place to be, place to hold assets. And we went negative. We stayed negative until 2016. Gold had made its low in 15 and turned up. So when did we turn bullish? It wasn't because the fundamentals drastically changed. They've since changed for sure. But the gold bottom came in before fundamentals changed. It just was underpriced. It made a low. We could see it on momentum. Very clear base was built, not price, but on momentum. And in February of 2016, as price moved up to 1140, we turned long-term bullish again. Let's go back to like 1970, before it was futures market. It became futures market in January of 1975. But there was a bull market going on in the London bullion market. And basically gold went up 7 to 8-fold during that 5-year period. It peaked $200 when it began trading in New York in the COMEX in January of 75, but it had an 8-fold move. Okay. Then you had a bear market, cut it price in half, down to $103.50 in the summer of 1976. And by 1980, you'd gone where? About $850. 8-fold move.
Yeah.
Okay. If you look back at the bull markets in gold over the last 40, 50 years, they've all been about 8-fold moves. Okay, where was the last bear market low? 1,050 area. Okay. So when you say gold could go to 8,000, you're not saying anything more extravagant than what happened in the prior three bull markets in gold the last 40, 50 years. Went up eightfold. Now, we're in different times now, so I admit that even that 8,000 may just be a routine, another typical gold bull market. And it wouldn't surprise me it goes way beyond it.
Okay.
Gold is not on its own here. We've got a crisis of major proportions that's been building in asset categories over the past decade plus that has created price distortions, false investments, false notions. And when they come unwound, when the error is exposed, sometimes the reversion to correct the error is even more dramatic than the error itself.
Okay.
And it wouldn't shock me that certain things go down more than they probably are justified to do, and some things will go up more than justified. Markets often overshoot, right?
Yep.
Well, let's talk about the silver question, $200. Well, silver is definitely very much restrained to gold. Right now, it's outperforming again. In other words, over the last year or so, it's been an outperformer to gold. So it's been better to own silver the last year and a half than it has been to own gold. And it's likely to continue that way for the next couple of years. But why $200 on silver? Well, it's more or less a logarithmic scale measure where we look at the prior peaks. There were two peaks, 1980 and in 2011, they were either side of $50.
Yeah.
And in between, we were down to as low as, recently as $11. And after the first time to 50, we went down to, I think, about $5. But when we look at a logarithmic scale of silver, it looks like not only should it, one, go up to challenge the two prior highs, but take them out and probably go as much on a log scale beyond that as they've been living below that dual peak. And that would put silver more in line with gold. In other words, it would catch silver up to what gold has done. Gold hasn't hit multiple highs in a flat level. It's made higher highs each time. Silver hasn't. And I think silver's about to unleash in a way that not only takes out the dual highs, gives you a triple top breakout above 50, but catches up to gold on a long-term basis. And as long as we see, one, gold in an uptrend, which is not being threatened whatsoever by this protracted pullback, and two, silver on a spread basis continue to outperform gold, which it's doing, we'll continue to hold with the idea that, one, gold's probably going to 8,000 minimum, and silver's going to catch up to it historically. And I think there's some other folks that have come up with numbers like that, even higher than 200. Markets tend to swing in excess. We know that. Stock markets frequently go way beyond their reality. We're there now, okay? And also when they collapse, they go way beyond their reality.